Is this just a battle between the fears of a hard landing versus a soft landing being possible?
Yeah, I think we're in the camp of the soft landing scenario actually, and we do think that in this kind of situation that we don't really have to be completely overweight in fixed income. We do think that where the asset allocation is concerned, we do favor a more defensive posture in the sense that, as you've rightly pointed out, healthcare stocks are actually one of the more defensive sectors to be in, and they've actually proven over time that they tend to actually outperform in the late stage of the cycle. Valuations are pretty attractive at this point in time, and of course the sector on its own is also not as leveraged as the other sectors, and therefore in a rising rate environment they tend to do better in the sense that their cash flows are not as badly affected as the rest of the other sectors.
Is that also why you're preferring value stocks with inflation still being high? I mean, this chart on the Bloomberg is showing what Treasury rates have been doing, and the longer end has really led those declines. And we saw value stocks not really performing the way that they were expected to perform, and that's given the upper hand to growth. So when you're in this environment where we're really not quite sure where we're headed with inflation also elevated, what is your stance on value versus growth?
Yeah, I think in the last month you've seen that the growth stocks have actually outperformed, because I think the first half of this year the growth stocks really got pummeled as a result of the interest rate environment. But we do think that this rally that we had in the growth stocks in the last couple of weeks is just a bear market rally. We do think that where the longer term horizon is concerned, we do see rates going up even further from here. And in fact, our forecast on the 10-year yields is roughly at about 3.25%. And if that's the case, that means that where the growth stocks are concerned, they are likely to be more vulnerable going forward, at least over the next 6 months. So in that sense, we do think that the value stocks are likely to actually do better. And there are some of the sectors there, the dividend yields are actually pretty attractive. For example, the oil and services sector. We do think that where the oil prices are concerned, this is just a temporary reprieve. We haven't seen demand destruction in most of the major economies, with perhaps the exception of China. And we are yet to actually enter into winter. So we do think that oil prices are likely to actually trend back up to the $120 to $125 per barrel levels where Brent is concerned. And that in turn should actually provide some reprieve for the oil services stocks, as an example.
The supply chain issues continue. The war in Ukraine is continuing to drag on. When it comes to geopolitical risk, is that becoming a more major focus when it comes to strategy going forward?
Yeah, I think in the last 3 years we've seen that geopolitical risk, especially after President Trump got elected, has become one of the major focus for a lot of investors, and that they tend to actually try to shy away, or they tend to actually reduce their allocation to sectors or to areas where they think could perhaps be at the forefront of geopolitical risk. And that's something that we have to deal with going forward. We need to focus on the fact that, where the asset allocation is concerned, we need to actually be more aware that perhaps geopolitical risk could increase the volatility of the portfolios, and therefore, a more defensive stance could be warranted in that sense. And that's one of the reasons why we've actually been advocating a higher allocation towards the alternatives, in particular private equity, private debt, because we do think that these asset classes tend to be a lot more defensive, tend to be a lot more sheltered from geopolitical risk compared to the public markets, actually.
Do you like any tech exposure at the moment, particularly when it comes to the valuations?
Yes and no. We do think that where the market's concerned, if we look at the valuations, the US markets are actually pretty expensive, even at this point in time. I think they're basically trading at close to about 18.5 to 19 times earnings, whereas on a 20-year basis, the US stock market tends to actually trade about 15.5 times. And with your rates likely to actually increase, and with us going into this Jackson Hole weekend, we do think that the Federal Reserve is probably going to use this weekend to reiterate the fact that rates have more room to climb, because they really want to bring inflation down. So if inflation doesn't come off, the rates don't come off. And I think from that perspective, we do think that where the US equity markets are concerned, perhaps is a little bit expensive compared to the rest of the markets at this point.